Namaste to all. I welcome you to this an interesting panel discussion through webinar on the recent opinions issued by the Expert Advisory Committee of ICI, one of the oldest committee in the institute, the Expert Advisory Committee, which was formed in 1975. It has got the whole process of how the questions are received, how the opinions are issued, what is the process. But yes, today we are discussing upon certain few selected recent opinions. What was the facts, what was the question raised, what was discussed, and what was the ultimately opinion. Because it is not one or two persons, it is a whole group of various experts who do it. And we have got two eminent panelists out here who would be sharing their views on the recent opinions which have been issued by the Expert Advisory Committee. The foremost we have CA Jayant Gokhale sir, who's a very prominent member of our institute, who is a past council member and for more than 12 years. He's from Mumbai, and he is independent director of quite a few companies, including PTC, PFS, SBI, DFHI, and also chairman of the audit committee of L&T Mutual Fund Trustee Company. Also, he was formerly the independent director on the Syndicate Bank and also of its audit committee, and also LIC Mutual Fund AMC. And he has been a member of various committees of RBI for the merger amalgamation, standing committee of the IRDA, and of course the ASB of ICI, which at that time laid the roadmap for the Ind-AS conversion. And he has been chairman of various committees, vice chairman of various committees in the institute, also including the ASB, and of course he's over the last 2 decades he has been associated with numerous academic activities, including framing and adoption of 24 accounting standards, Ind-AS, and I would say he has been the chairman of this very committee, the Expert Advisory Committee, for few years, and also a permanent inventory for the many years. So his knowledge of framing an opinion and coming to a conclusion which requires a lot of technical input has been very, very helpful to the whole institute. He has been appointed by the Government of India as member of various technical committees, Ministry of Finance, SEBI. His whole, if I see his biodata, it is much more than it will take more time than we consume on the opinion. So welcome CA Jayant Gokhale sir, our past CCM, past chairman of the EAC. Also, another panelist which we have today is another very, very important and very known personality, CA Archana Bhotani, who is more into academics, I would say, and any person who is aware of Ind-AS or the technical inputs on the Ind-AS knows her very, very well. And her contribution to the ICI is also very, very immense, very, very important. Wherever we find the institute finds any issue to be discussed with full frankness, okay, all inputs with very strong views, wherever she takes with the legal backing. So we always come back to Archana Bhotani out there, who's got more than 20 years of experience. And though she doesn't look like that, but yes, she's got that experience. Also, she has been a regular contributor to ASB, EAC, being a corporate member of these committees, and also she has been a special invited to NACAS and various other committee of ICI and the Ministry of Corporate Affairs. To moderate these two stalwarts, we have got another stalwart in CA Vivek Nevatia. He is, of course, having more than 17 years of experience. And again, he has been contributing to both the ASB and the EAC wherever required, and his inputs are always very, very welcome. He has been he has taken a few various webinars and been a speaker out there at the institute level many times. So I thank you, Vivek ji, and I welcome you for accepting to moderate these 2 stars. It would be a Herculean task, but I know with your ability you will be able to do that very, very wisely. But we have another our gentleman who is the vice chair of EAC, and in fact he is driving the EAC. So any opinion recently, since the time he has become the vice chair of EAC, it doesn't pass unless our vice chair, say Vishal Doshi ji from Vadodara, he approves. So his knowledge, his acumen for the accounting standards, the accounting, the auditing, because he's also the vice chair of the Accounting and Assurance, Auditing and Assurance Board of India, of our ICI, and few other also Board of Studies academics. He is the vice chair who has brought in this crack. So his contribution to our institute is immense, and to EAC tremendous, because looking into what we have all brought in the I would say the opinions to bring it closer to issuing it with a prompt timeliness has been a really hallmark of our vice chair. So before we start, I'll request our vice chair to share his brief thoughts about how this EAC works. We have been having various webinars of from various other technical committees, but this is one of the oldest committee of ICI and plays a very, very important role. Very, very important role, not only for the members, but various regulators. So I'll request my Vice Chair, Sri Vishal Doshi, to please share his views about EAC with the members at large.
Thank you, Chairman, sir. Very good afternoon to all the participants, and a special welcome and a good afternoon to the panelists and the moderator, Jayan ji, Archana ji, and Vivek ji. Friends, at the outset, I would like to thank our chairman for this being the first webinar. Let me be candid. This is the first webinar that we are doing under the EAC. And it was the brainchild of our chairman who suggested that though we come out with the compendium and other modes of communication, but webinar is one of the modes which we should start to explain the opinions and make it more user-friendly, more interactive also. And that is how we are here today in front of all of you with this panel discussion on some of the key opinions that have been issued in the recent past. Friends, just since it's the first webinar, we thought that we'll just take a glance through how the EAC its important roles and responsibilities. So I've just shared my presentation on how the EAC functions and what are the means in which it delivers. So typically the EAC is constituted as an
Vishal bhai, the screen it was not being shared.
Sorry. I think I had just logged off. Just a minute. I'll share it once again. Yeah, so the EAC is constituted by the Council of the ICI and primarily to answer queries of the members of the ICI, and the queries should be on accounting and or the auditing principles related issues. And it has its functions under the advisory service rules, which we'll take up in a bit detail later on. So this is a brief about the EAC. The terms of reference of the Expert Advisory Committee is to reply to the queries on accounting, auditing, and allied matters that are received from the members of the institute, and now also to publicize and create awareness about the opinions issued by the committee by various means, including publishing the compendium of opinions, which contain the opinions which are given by the committee. So, brief overview of the committee. It is one of the technical non-standing committees of the ICI, which was constituted in 1975. Though it was already answering queries since 1961 as part of the research committee of the institute, and the queries that are being answered, that are being responded by the EAC, are considered regularly in the various meetings of the committee that are held. Until date, the expert advisory committee since inception has held 241 meetings and has issued, or I would say finalized, opinions of almost around 1600 opinions that have been finalized by the committee. The rules under which the EAC functions. So one of the rules is that it would deal with the queries which are relating to accounting, auditing principles, and allied matters, and it will not answer queries which are relating to legal interpretations or matters involving professional misconduct. So it is only with respect to accounting, auditing principles, and allied matters that the queries would be attended to, and only queries which are received from the members of the ICI would be answered. So these are the couple of rules which are there. Definitely the EAC charges fees for the opinion that it gives, and there are thresholds which are given for listed enterprises based on the annual turnover, as well as for the listed enterprises, again based on the annual turnover, that the fees are charged or levied for the opinions that the EAC gives. And these are all turnovers which are in the immediately preceding financial year that are thresholds are applicable. So how does the process actually start? So one requirement is that the declaration is to be given by the querist, where it should consist that a declaration that whether the equity or the debt securities are of that enterprise to which the query relates to are listed on the stock exchange, a recognized stock exchange, or not. What is the annual turnover of the enterprise to which the query relates based on the last audited annual accounts, and whether the issues they involve any query which are pending before the Board of Discipline or the DC, any court of law, income tax authorities, or any other department of the government except the C&AG. So this is a declaration that has to be furnished by the querist. As we have discussed, the queries, they are relating to accounting and or auditing principles. They should be specific queries relating to specific matters and should not be general in nature, and they should be self-contained and a complete query. So whenever any queries asked, these are the things that the queries should keep in mind. And what is expected that the queries should provide: one, nature and background of the entity to which the query relates, any agreement, contract, MOU which is referred to in the query, other correspondences which would be there, annual report for the immediately preceding financial year, clarifications or details which are sought by the committee, and alternative solutions or viewpoints. These are optional. But many times you will find that the queries also gives their viewpoint or solution, and then they further want it to be answered by the expert advisory committee. But the queries should support and provide all the relevant facts and documents along with the query to help the committee to answer the query on a timely basis. Because if incomplete documents or information is received along with the query, then the committee again has to go back to the querist, and again those documents are sought for, so that takes time. Specific queries on accounting and or auditing are also referred by the government and regulatory authorities to the expert advisory committee, like the C&AG, the MCA, SEBI, RBI, etc. And to these regulatory authorities, there are no fees, and their opinion is given or the queries are answered without any charges. Now, what is the process? So once the query is received to the committee, to the EAC, what is the process that is being followed for finalization? So the query is screened threadbare and researched thoroughly by the committee secretariat. Then they prepare a draft opinion, examining the generally accepted accounting principles, and also which comprise of the accounting standards, the Ind AS, guidance note, framework or conceptual framework under Ind AS, which is issued by the ICI, the Companies Act, or other applicable relevant statutes, international gaps and practices. So all these things are kept in mind, and a draft opinion is prepared by the committee secretariat. Thereafter, the draft opinion is considered by the committee, the expert advisory committee, at regular meetings that are held of the committee. deliberations, discussions, and I can say at times we've seen that one opinion is discussed for 2.5 hours, the draft opinion, and then also it remains inconclusive with some with additional information that is sought. So that is the level of discussions and deliberations that happen. And the members of the committee are those are all members who are having sound technical knowledge and a wide experience of working with different industries. And all aspects relating to the query are discussed and deliberated, considering the relevant applicable accounting and auditing principles. What is the authority that is attached to the EAC opinions? So the opinions, they represent the opinion or views of the members of the committee. So it is not an official opinion of the council, and therefore it is neither mandatory nor recommendatory in nature. But overall, like you have seen already, about 1600 opinions have been issued, and they are well recognized by the corporates as well as the statutory and various regulatory authorities. Coming to the publications, so far 41 volumes of the compendium of opinions have been issued, and these opinions, they contain all the opinions that have been issued during a year, and opinions are published. They contain what is the date of finalization. So many times when you refer, you would also be referring to that some opinion is of 98, some is 2008, and then maybe you can just relate with the existing technical guidance that is there with respect to that opinion. And therefore, opinions must be read and applied after taking into account any amendments and or developments subsequent to the date of finalization. The opinions, they are available on the website of the institute also, and you can order the hard copy from the CDS, the Central Distribution System portal, by making online payment. So there is this online resource also that is available for the opinions, EAC opinions, and IT search application. It is available, which has advanced search facilities. That means you can have a volume-wise search, you can have a global search, you can have an advanced search also. And there are also recent opinions, so which are not available in the hardbound compendium of opinions so far, but they have been issued by the EAC. You will find them under the recent opinions tab in this IT search application. And all the volumes which are published are also available on the Digital Learning Hub platform of the Institute. So with that, so this was just to give an overview of what the EAC is and how it functions. And I am confident that you would have a very, very interesting session today, and we would definitely have more such sessions in the times to come. Thank you very much.
Thank you, Vishal sir, for giving a fantastic overview of what and how the EAC works, and especially at the end when you shared that link. More than 1,000 members are already hooked up right now, which I suppose by the end of the session would grow. They should be very, very. It would be a pleasure for them to see that if they search through that link in their normal practice for accounting and finalization of the financial statements. So various opinions that they put in their keywords and they can search, okay, what was the opinion which was held by the EAC? Some questions have already started pouring in, but one of the questions is that mandatory or not? That Vishal sir has already informed that it is not mandatory, but the basis which has been given in that opinion, which forms a legal background, so that can be used. It is not that because of this opinion that becomes mandatory, but the background which is there, which is legally verified, that can be used by our members. So I request all the members who are seeing, and they can tell to their friends, these all opinions, more around 1600, which has been done over the years, please use them. This is your own asset. This is an asset created by your own ICI. Please use this extensively. Put the words you want to search and see, okay, what was the opinion thereon. This would improve our own professionalism of our practice. With that, thank you, Vishal bhai, and I request now Vivek Nivatia ji to please take over for the interesting session.
Thank you, Chairman sir. Thank you, Vishal ji. A very good afternoon to the panelists present. A very good afternoon to the delegates, 1,000 odd delegates who are attending this webinar. Well, it's a wonderful initiative taken by EAC to disseminate information about the recent expert advisory committee opinions. I think this will go a long way in disseminating the knowledge which the EAC actually deliberates on and discuss on the principles which are put forth by these EAC opinions. What we will do is we'll discuss each case one by one and discuss the principles on the basis of which the committee arrived at the conclusion, and also discuss on the conclusion. So we'll limit ourselves to the opinions which are there, which we have identified. And let me say that the committee secretariat has done a wonderful job in identifying the cases which are of practical relevance. And although the opinions are very fact specific, but the principles which are laid down actually help us in dealing with the daily issues that we face while dealing with accounting problems. I'll just share my screen and then start with the case study one. The first case study, which is in respect of wherein we discuss the principles which are laid down under Ind AS 110 on consolidated financial statements and Ind AS 23 on borrowing costs. We discuss about very important principles of consolidation and capitalization of borrowing costs in the context of standalone financial statements versus consolidated financial statements. In this case, the company which was there is engaged in the business of exploration and oil production of oil and gas and hydrocarbon related activities. This company carries on these activities through overseas companies or through itself. What the company did was it acquired 60% shares through a secondary market purchase in a company overseas subsidiary, let us name it X Limited, which was having a 10% participating interest in an overseas discovered oil and gas project under development. Now, the purchase consideration for the acquisition in the context of the standalone financial statements of the Indian company, when we look at it, was financed partly by market borrowings and partly by internal accruals. And on the right side of the balance sheet, on the asset side of the balance sheet, was the investments in the overseas entity acquired through the secondary market purchase. Now, the entire borrowing cost from the context of standalone financial statements were always charged to revenue, and there was no project which was under development in the standalone financial statements. Now, when this acquisition happened through the secondary market purchase, and the acquisition was financed through market borrowings and partly by internal accruals, the borrowing costs which were incurred on the borrowings were charged to profit and loss in the standalone financial statements. In the context of consolidated financial statements, the company continued to charge off the borrowing cost as an expense. Now, the CAG was of the opinion in this case that though the company was correct in charging of the borrowing costs relating to the borrowings made for the acquisition of shares in the subsidiary company as an expenditure in the standalone financial statements, the same principle would not apply to the consolidated financial statements. What CAG said that the company should have capitalized such borrowing costs with the cost of the related assets under construction of the subsidiary company. Because when we look at CFS or the consolidated financial statements, we look at the entire group as one entity. And therefore, since the subsidiary as part of the consolidated financial statements was undertaking a project, this interest cost which was incurred by the holding company should be added to the cost of the asset concerned in the CFS concern of the company. As per the company's version, the Indian company's version was these assets under construction were acquired by the company not for the primary purpose of acquisition, but as an incidental takeaway of the acquisition of the participatory mineral rights in the underlying projects, which was the main intention of acquiring the subsidiary company concerned. Now, the question which arose here is whether the company was correct in not capitalizing the borrowing costs associated with the borrowings made for acquisition of shares in subsidiary X with the costs of in-progress assets held by the subsidiary company and charging of the same as expenditure in the separate as well as consolidated financial statements. So what we will discuss here is the principles of consolidation and the principles of capitalization of borrowing costs to qualifying asset, and how and under what circumstances whether an item of expenditure is treated differently in separate and consolidated financial statements, and whether the line-by-line consolidation is to be taken literally. I would request Mr. Gokhale to throw some light on this case. Sir, would you please? Sir, you're muted, please.
Yeah. Before I take up, I think Archana ji, would you want to come in and make some observations so that then I can go ahead?
Yeah, sure. So, and I think, sir, just to kind of add to what Vivek said, some of the aspects on which it'll be interesting to get your perspective. I think when we look at this scenario, 2 or 3 very big issues really come up, in the sense of what, if I look at this fact pattern, what is the qualifying asset? Is there a qualifying asset actually here? That is one bit. Maybe we can start with that, and then I'll come on to the other bit, which Vivek had also raised in terms of line by line. That I think is a very important one. We can start with you that when you look at a fact pattern like this, because there is reference to investment in the subsidiary, and then there is reference to investment by the subsidiary or the participating interest of the subsidiary in the project. So when we're looking here and applying IAS 23 or Ind AS 23, what is the asset for which we should test whether it's a qualifying asset or not?
Perfect. So I think let's start with that. As you said, let's look at that as the first aspect that we examine. And the first point to emphasize within that, which of course the committee has done, is that a qualifying asset is of course defined in Ind AS 23. More importantly, it is at from every financial statement preparer, so every company or every entity, that you have to judge the qualifying asset, not just based on the characteristics of the asset, but the characteristics as viewed from the investing company's perspective. And this, in this case, was very, very important, because actually, if you see the fact pattern over here, the company which has made the investment has actually invested in equity shares on the secondary market, which is very crucial. It is the subsidiary which is holding a project which can be possibly falling under the concept of qualifying asset. But whether the company which has invested in a qualifying asset is a thing that has to be judged independently. And to say it briefly, I would say that in this given case, the committee rightly considered that no, the company has invested in shares which are reflected as an investment, which by no means of imagination can be a qualifying asset. It doesn't take time to acquire shares. Doesn't necessarily take, although some negotiations can be protracted, but doesn't necessarily take time to acquire shares. Therefore, it doesn't fit into the qualifying asset concept within the holding companies or the parent company's situation, and therefore that qualifying asset test would not be met. That is what the committee concluded in this case.
Let me just take this qualifying asset bit only forward, sir. Now, can it be, maybe not in this factor, but just kind of, and maybe we can take 2 examples. Can it be that when I look at the separate financial statements, I'm looking at it with respect to an asset X, whereas my consideration for CFS changes. So for example, and maybe then we can see how does it fit in here from a CFS perspective. So let me just take a very simple example. Let's say I as a parent had invested in a subsidiary. I've given them equity and so on. But I have taken loan to make that investment. Okay, so I've got a borrowing, but I don't have a qualifying asset, like you just said, because I've just got equity investment, and that is a secondary market, so it doesn't meet the qualifying asset test. So when I look at the standalone financials of the company, my asset under consideration is investment, which doesn't meet the test. When I look at the subsidiary, which this query doesn't really get into, the subsidiary has an asset which is a participating interest, but it does not have a borrowing. Right. So what happens is that at a parent level, there is borrowing, but no qualifying asset. At a subsidiary level, there is no borrowing. There may or may not be a qualifying asset. But when I look at the CFS, we say that it becomes an economic entity. Let's say the underlying asset by the subsidiary was a qualifying asset. It had invested in maybe in some kind of a construction of a machine or some, power plant, which meets the test of a qualifying asset. When I look at a consolidated financial statement, then should I say, because this equity will get cancelled out, the investment and will get cancelled out. Can I say then at a CFS level, there is a borrowing and there is a qualifying asset, and therefore the consideration or assessment at CFS can be different from that as at SFS? And in some cases it can be, and maybe in this case, the answer probably may not change, but you may just want to kind of kind of even take us to, would you apply a different lens when looking at CFS?
Yes, I think very valid point, Archanaji, that one has to look not just independently, but one has to see the sequence of transactions right through. Because as you rightly put it, when doing consolidation, you have to treat the entire economic entity, including its parts, as one single entity for the purpose of consolidation. And in fact, one of the facts quoted in the query, they have cited from one of the study material of the ICAI, where a similar example had been quoted, where in fact the opinion or whether the view expressed in the ICAI material was that there was a direct investment similar to what you mentioned. There was an investment made by a parent into a subsidiary by acquisition of shares, and that money virtually directly, although via the subsidiary, actually flowed into the asset for financing the qualifying asset.
Right.
That is precisely the point of distinction that the committee has made over here. That while in such second case that we mentioned, that if there is an indirect flow from parent to subsidiary to qualifying asset, but when considered as an economic whole, it really means that the borrowed funds are utilized, though borrowed at the parent level, but utilized in the subsidiary, are effectively flowing into the qualifying asset. So that is what the example said. But that is precisely what the committee actually rightly zeroed in on, in saying that the fact pattern in the example given in the study material or institute material and the fact pattern over here has a one important distinguishing feature, that in this case, and which Vivek brought out, that in this case, the investment was not made into the subsidiary, the money flowed to the third party because it was actually going through a secondary market purchase. So really one cannot directly attribute, and the word directly attributable is very, very crucial, because undoubtedly once you have acquired the parent has acquired the subsidiary, there may be some flows here and there, but it can't be said to be directly flowing to the qualifying asset. And therefore the committee took the view that in this case it did not meet that test, and that's how they have taken the view that there is a distinction between the fact pattern as given in the illustration that they have cited and the fact pattern in this company. So that was one of the important features that they have highlighted.
So if I was just to kind of, for the benefit of the participants, if I was just to make sure I've also understood your point correctly, when I look at the SFS, standalone or separate financial statements, we are saying the qualifying asset test is not met because the borrowings have been used, let's say, to buy shares, and shares do not take substantial period of time to get ready. So the qualifying asset criteria is not met at a separate. Now, when I look at a CFS level, while I will look at parent plus subsidiary together, in this case, by the time the parent invested in the subsidiary had already acquired the participating interest. So like you said, it is not that the money that, first of all, the money did not really flow into the company. Like you said, it was a secondary market purchase, so it went to the existing shareholders. But let's say even if the money had come into the company, if the asset had already been acquired, right? My funds were not used, that asset was already sitting in the books of the subsidiary. Even then the test would not meet, because while there is an asset under construction or, under development, the borrowings are not directly attributable to it. That's the sense I get. So in this case, okay, so even at separate as well as consolidated, it would not meet. I think that's a very interesting point.
So in fact, just to wind up, I think more or less we have come to what the committee concluded, but just to take your point a bit further, let me give first the reverse situation, that hypothetically had the company borrowed directly, the subsidiary borrowed directly, then perhaps it was a case where it could be treated as a qualifying asset, and that in the subsidiary it would have been then treated as an item that could be capitalized. But as you rightly said, in the given case, I believe the committee rightly came to the conclusion that since at the consolidated level, there is no intra-group transaction in terms of flow of funds for financing the qualifying asset, nor is there in a consolidated sense also any directly attributable borrowing cost which can be identified, and therefore the treatment that the interest cost borne by the parent company should continue to be accounted for as an interest cost which is debited to expenditure and not capitalized is what the committee ultimately concluded based on this fact pattern. And I think very rightly so.
Yeah. And so one more area, just for the benefit, maybe we may want to elaborate. It's more from the perspective, the point which was put forth by the querist rather than the committee. But I think it's important, and I also feel because many of our participants maybe rather than Indians, they may be looking at AS. So I just kind of wanted to bring that in. Is that, from the company which had raised the query, as I understand, their point was also that in CFS, I will do line by line addition. So they were on a very different track than what we discussed, wherein we said we look at an economic entity. I may, in my separate, the qualifying asset could have been X, whereas in CFS it's a different assessment. The company took a position that I wouldn't make a different assessment for CFS. They said all that I will do is line by line addition, and I think this can be probably an area of knowledge gap in many, because probably that is what we did in AS, and you said, okay, let me do line by line. And while we've discussed this already in our, just a few minutes back, I'm just reiterating that you will make a separate assessment and it will not be a simple line by line consolidation. I think, frankly, if you ask me, sir, even under AS, I would have been, you could have argued two ways, because AS 16 was silent. In AS 16 also this question came up. Should I do a similar analysis wherein I identify that parent has a borrowing and subsidiary has a qualifying asset and then look at it together for CFS, or should I do just line by line? And there was diversity, frankly, if you ask me. But I think the EAC in some other context under AS came out with a position that you do line by line. So if I'm correct, after the EAC opinion under AS, would now the approach be different, that for AS in the same situation like we were discussing, you would just do line by line consolidation, but in AS you would do a separate assessment for CFS?
Absolutely. I think I entirely agree. This point needs to be emphasized. In fact, there are other opinions of the expert advisory committee under Ind AS which have taken a similar view, that one has to take not just a line by line, which was the concept under the AS. But insofar as Ind AS is concerned, in fact, there are other opinions. For paucity of time, I'll not get into that. But where they have looked at the broader picture, and one takes, the concept of seeing that as a single economic entity has to be carried to its logical conclusion, and not just looked at piecemeal and go line by line as a mechanical exercise. So I entirely agree.
Yeah. So many feel that
the answer would have been different, and perhaps different. I would not say different necessarily, but perhaps different. There, I would have given more emphasis to line by line, but here, definitely the view that has been taken is the appropriate view. Yes, sir.
And yeah, I think the only point I was adding was that, when somebody reads Ind AS 23 and AS 16, apparently they seem similar. So one could say, why is your answer different? And I think we need to realize the answer is not necessarily different because of Ind AS 23 versus AS 16. But it is more coming from the way consolidation as a process happens. So the key difference in the consolidation process leads to maybe a difference between AS and Ind AS. I mean, would that be, that would be correct, right?
Absolutely. So to conclude, in this given case, we have the EAC concluded that there is no interest capitalization to take place, and the treatment that was being adopted by the company was appropriate. That is how it was concluded.
Okay. I don't know whether Vivek has any comments. Vivek?
No, very wonderfully summarized. So I think the process of consolidation in accounting standards vis-a-vis Ind AS, I think is a differentiating factor, as pointed out, as to how we look at consolidated financial statements from an AS perspective vis-a-vis Ind AS approach, wherein as per Ind AS, we look at a single economic entity approach, so as to say. And line by line consolidation would have to be looked at from an intent perspective also, maybe. That is something which, again, is something which is a question that we always ask ourselves as to how the process of consolidation actually works when we look at it as a single entity. I think wonderfully summarized by Archanaji and Jayanji. Sir, thank you, sir.
Do we have any questions at this stage on this query? Maybe we can take, if there's any questions on this.
I'm not sure because this is, I think, on the Zoom platform, I'm not able to see any questions.
No, it will not be on the Zoom platform. We should go further on this, and if the questions are there of the participant, we'll take at the end, right?
Sure. Coming to the case study 2, it's on Ind AS 116, and considering Indian context, I think this or concept on perpetual lease, I think, is a perennial issue when we look at accounting. And I'm informed that Archana ji's favorite topic is Ind AS 116, so none better than Archana ji or to deliberate on Ind AS 116 and the issues which we face when we discuss on perpetual leases. So coming to this case study, we discuss about a company which is engaged in the business of refining and marketing of petroleum products, chemicals, gas, and electric energy. The company has taken land at various locations on lease with perpetual lease time period, and for which there were two payments which are required to be made. One was the upfront premium, which was paid at the time of commencement, and a nominal rent, which was payable on a periodic basis. The default in periodic rent may lead to cancellation of the lease agreement. There were various restrictions, covenants which were imposed by the lease under the lease deed, wherein there was restricted usage in terms of land usage like office, fuel station, etc. were the restricted use. Also, there were restrictions on how the layout of the plan can be changed under these lease agreements. So what the accounting treatment was followed in respect of this lease of a perpetual nature of land was that since this perpetual lease is not covered in the exclusions of given in Ind AS 116, leases of perpetual nature were also covered within the ambit of Ind AS 116. So we are all aware that Accounting Standard 19, the earlier AS framework, excluded land from the purview of leases, but Ind AS framework includes land within the purview of leases also. So what the company said that since it's a perpetual lease, there's no exemption for perpetual lease given in Ind AS 116. Leases of a perpetual nature would be covered within the ambit. The lease liability would be measured as the present value of lease payments using the company's borrowing rate, and no unwinding is done. The right of use asset is measured and recognized at the amount equal to the lease liability plus the one-time amount upfront premium paid, and no amortization is made because the asset is in question is land and would have an indefinite useful life. So therefore, the ROI, there was no question of amortization of this ROU asset. This was what the company contended. The finance cost was recognized on the outstanding lease liability, which was equal to the lease rent as and when accrued. Now, the concept of perpetuity, present value of perpetuity, was used to decide on the present value of the lease payments which are required to be made, which was cash flow upon the implicit rate of interest. And therefore, that amount was recognized as the lease liability. And what the company contended that the lease rent paid was debited to the finance cost, and that amount would continue in the financial statements forever. Now, what the observations were of C&AG were, the C&AG observed that since this is a perpetual lease, there is no definite period of time and no termination clause. The company has an enforceable contractual right to use the underlying asset till perpetuity. Thus, in substance, this becomes a form of ownership interest. So there was a difference. So what C&AG contended was there's a difference between a perpetual lease and a lease with a defined period of time, and therefore, since I'm able to use the asset till perpetuity, this is one form of ownership interest, and therefore this land which I'm acquiring by payment of upfront payment would be treated as a freehold land and not ROU asset. So this was the contention of the C&AG concern. However, the company's contention continued to be that this leasehold land should be classified as ROU asset. And what it differentiated between is what is control. So it said that I do not have complete control over the asset concerned. There are restrictions which are imposed upon as per the lease agreement as to the use of the asset concerned. So in case of perpetual lease, what it said was control is not being transferred to me, and therefore I cannot treat it as a freehold land, and it should be recognized as an ROU asset. So there were multiple questions which were raised here, which was whether accounting treatment and disclosure of recognizing this ROU asset, lease liability, and finance cost was in order, whether ROU should be amortized, and whether any unwinding entry is required for lease liability, whether perpetual lease is akin to a freehold land? And if it's a freehold land, how would it be valued? So these are very, very pertinent questions. And again, I would request the panelists to throw some light on the definition of control here, whether there's a difference between right to control or right to control the use of the asset concerned. Those are very, very pertinent questions when we decide on whether it's property, plant and equipment or a ROU asset. The concept of perpetuity or perpetual lease, we would again request the panelists to throw some light on this.
So it'd be good to have some comments from you before I share my perspective.
Yeah, sure. I think two important points from what Vivek has highlighted, very important, and which are at the crux of the issues. One is, that there is a concept that the whole thing arises that whether something which is leased for perpetuity can be considered to be a lease for a certain period of time, because the lease standard refers to the time period, whether this falls within that, including something up to infinity. And then a rather more basic question, can there be something that can be stretching up to infinity, in the sense that perhaps can we interpolate into that the concept that the business itself may have a possible life of say 70, 80 years. Say they are in the possibly business of fossil fuels. So can somebody take a view that perhaps 100 years from now, fossil fuels themselves will be outdated. So I'm going to put a life of 100 years or whatever. So is the perpetuity concept very important from determining whether it is a lease or an asset? That is one. And especially because the second critical aspect is land. Because the second underlying concept is that land does not depreciate, or land does not, and therefore, since the value of land is, Mark Twain had famously said that they stopped manufacturing it long back. So therefore, land has always an escalating value and never a depreciating value. So can one say that therefore there is no need for amortization? So these two issues, I think, are at the crux of the matter when one is considering the technical aspects. So I'd love if you could throw some light on that.
I think very interesting point. So the first bit that you've raised on perpetual, the fact that it's a perpetual lease, I actually find this fact pattern very interesting. And I think this fact pattern and the opinion throws up many, many conceptual issues. And what I'm going to do is, while I will discuss what the EAC opinion is, I think I would also I may take the liberty of just sharing a few personal inputs, beyond what the EAC opinion was, because this is a very peculiar fact pattern. I'm not so sure, while perpetual lease is common, but I'll tell you why am I saying this is a very peculiar fact pattern. And then I want to discuss perpetual lease in generality. So, sir, the first point that you made, perpetual lease, is there if you have something which is a perpetual arrangement, let me not call it a perpetual lease, if there is a perpetual arrangement, can it meet the definition of a lease? That's the first question. Generally, while the standard does not directly answer this, generally, a perpetual arrangement would not meet the lease test, because if you look at the definition of lease, it says where you have a right to direct the use of an asset for a specified period of time, which is what you mentioned, in return for a consideration. But I will also acknowledge the EAC has considered this to be a lease in the current fact pattern. And that is why I said I'm going to go a little beyond the EAC opinion. So in this fact pattern, probably the conclusion that EAC has reached is correct, but because the fact pattern is it's a bit odd. So generally, I would say a perpetual arrangement may not meet the test. But, if you look at the educational material that the Institute has issued for India S 116, there again, interestingly, they've taken a situation of perpetual lease, not of land, but of aircraft. So they said, I have a perpetual lease, and there they've said, again, it's the lease, and the lease term is equal to the economic life of the asset, rather, because obviously the lease term is the contract otherwise is perpetual. So it just throws up quite a bit of interesting perspective. In the aircraft example, education material saying you can, in this it's saying you can, but if I look at the lease definition, it says that there has to be a specified period of time. My sense is that even before, I get into that, let me just share one more thing with the participants. When you look at the basis of conclusion, there's a very interesting paragraph in the basis of conclusion, which specifically discusses long-term leases, And it says, especially in something like, let me just see whether it uses the word perpetual, probably not, but it refers to long-term leases, and then it acknowledges or it raises this question that should these be considered or covered only by the standard on property, plant and equipment rather than being covered as leases. So there they've acknowledged that there is no exemption under the standard for a long-term lease versus a short-term lease. And therefore, even if it's a long-term, I'm making a distinction between perpetual lease and a long-term. Long-term is not the same as perpetual. I think we should not confuse that. So there they've said long-term lease of land would be within the scope of the standard. But then they've also acknowledged that in the basis of conclusion, not in the standard, that if the control over the land is transferred to the, to the customer, then it should be accounted for as PPE rather than as lease. So if you can just understand my confusion, we're talking about perpetual lease, then there is some discussion on long-term lease. And then let me, just to add to the confusion of the participants, there is also another term or another arrangement which we typically see, which is called evergreen lease. Now, evergreen lease and perpetual lease are not the same. Perpetual lease is something wherein there is no termination, it just continues. Evergreen lease is that it automatically keeps on renewing. So let's say I have a lease which automatically renews every 6 months or every 1 year. The outcome is, one may say, is the same, but legally they're very different, evergreen and perpetual. So how do you apply this concept or this discussion in the standard that, even though there is a long-term lease, if it is structured, if it meets the definition of a lease, it should be accounted for under the standard rather than under the standard on PPE, unless and until you can demonstrate transfer of control. That's the starting point. Now, why did I say this fact pattern is peculiar? My sense is that a perpetual lease would typically transfer control. Okay. And typically, if I'm the party or the so-called lessor, I would recover my money. Okay. Why would, if I've given it on perpetual lease, which means other than what I'm going to get through the rental, I will get nothing else. But when you look at the fact pattern in detail, while Vivek has taken us through it, we've not put the numbers. Interestingly, the fact pattern says that the fair value or market value of the land is, let's say, around 21 crores. But when you look at the consideration or the present value, even to perpetuity and the upfront payment put together, that comes to something like 14 crores. Now, that doesn't stack up. If I have given an asset on perpetual lease, why would I get only 14 crores versus 21 crores? Right. So, and then the other peculiar fact pattern in this case is that usually in a perpetual lease, okay, that's why we said perpetual arrangement would typically, like I said, I'm using the word very consciously, typically, I'm not saying always, would transfer control as well. Now, in this fact pattern, there are many, many restrictions. Okay, the customer cannot do many things. I think Vivek did share those. So if you look at it, it does not really put me into the same position as an owner. I would have generally expected a perpetual arrangement to do that. And that is why I said perpetual arrangements typically would be out. But in this fact pattern, it's a bit strange. It is a perpetual lease, but it doesn't give me as a lessor full recovery. As a lessee, there are restrictions on you. So it doesn't really put you at par with an owner as well. And I think somewhere the EAC opinion very smartly, therefore, tries to balance these things out. And looking at the fact that there is no control transfer, like I said, the basis of conclusion does refer to the fact that if you transfer control, then you go to PPE, otherwise you don't. So while this is a perpetual arrangement, surprisingly, it does not transfer control. And because it does not transfer control, I think the EAC has said, even though it is perpetual, even though it per se very literally does not, one could argue, does not meet that aspect of the definition for a specified period of time, I think they've tried to come to a more balanced response to say, let it still be accounted for as a lease. Now, if you look at it from the financial statements perspective, it doesn't, in this case, maybe not really have too much of an impact because ROU is an asset, PPE would have been an asset. IFRS 16 or Ind AS 116 also permits that I can present an ROU asset either separately or as part of the PPE itself. So I can have, as a separate column within PPE. But yes, I think, but I don't want to therefore take away the question which the auditor raised. Okay, just because, yes, I could have presented it like this. The question is very much relevant. But when I look at it from a very substantive picture, from a reader's, the information which is going to the user of financial statement, is it providing the right information, etc.? I'm not worried on that account because yes, it will come as an ROU. But I'll stop at the first point on the perpetual lease unless until I have not, maybe I've confused the participants a lot, but I wanted to highlight that it's like I said, it's a very, very interesting fact pattern. You call it a perpetual. It is not for a specified time period, but surprisingly fair value not recovered, surprisingly restriction on restriction on use is so much that it even fails to meet the control criteria. And that's where the answer lies. So when you do apply this, the search facility is there, and I find that database of EAC very, very, very useful. I use it very frequently, let me say that. I just want to caution the participants that please apply this opinion very carefully. Just because you see the title of a perpetual lease, do not presume this will fit your case. This perpetual lease arrangement is very different from what we typically see. And therefore, when you are looking at it in terms of the fact pattern that you may have, just be very careful how do the fact patterns stack up. That's the point I wanted to kind of make, yeah.
In fact, if I'll just come in and supplement, you'll remember once long back when in the EAC we had discussed that my original background is tax. And I know that a lot of our people are very much influenced by the tax considerations, although I entirely agree that in considering these questions before EAC, and Archana ji, you have not confused us, the issues are confusing. In fact, I think it's good that the participants are getting a little bit of a taste of what actually issues are tackled by the EAC, and sometimes people wonder why you need 3 sessions to answer one question. They feel that it's all of us are killing time over there. Some of them in a lighter way, I may say. But why I wanted to bring out is that very often our mind is not able to compartmentalize this thinking. And therefore, 2 important facts that I thought I'll just place on record. One is that under Income Tax Act and what happens under the EAC can be quite different. Under Income Tax Act, I know that a transfer of this nature, and the EAC has considered at length the documentation that is there, could result in anything vested for more than 12 years results in a transfer under the Income Tax Act. But don't get misguided by that in the accounting concept. So I thought that concept is there. And underlying logic everywhere, even Supreme Court decisions on tax, 4 concepts have been emphasized that when you want to have ownership, and there I come back to the correctness of the EAC view, that what is characteristic of that is ownership means it is enjoyment, possession, enjoyment, right to disposition, and peaceful possession. Now, if you really look at it, the right of disposition does not remain. Enjoyment also is very curtailed. So even if I were to look at, somebody comes across and says that, see, under income tax, yes, possibly under Income Tax Act, you may have to treat it as a transfer. But under the accounting concept that we are dealing with and EAC is restricted to, don't apply that concept over here. What Archana ji has said, that perpetual is a slightly difficult thing, and that is where the challenge is over here. But in substance, the concept that even that has a time limit in a sense also I think has prevailed. So I would absolutely agree with your view, Archana ji, and also the view obviously taken by the EAC. But I thought, let me just bring in this aspect that sometimes the fact pattern leads us in, there are red herrings along the way. Don't get pulled along that direction. You need to focus on what is the critical factor. And I think Archana ji has rightly highlighted that. And other than that, I would just want to say that then the query moves on, that assuming that that is there, how does one measure the value and how does one amortize, or do you amortize land at all? So if you can throw some light on that.
Yeah, but sir, sorry, before I go there, I just wanted to, just 2 bits which I wanted to know while I did, in terms of what I've said, I just wanted to kind of summarize 2 points. One is in this fact pattern, the Institute has taken a view that the fact that there is, even though it is perpetual, that will meet the test of specified period of time. Similarly, in the educational material they have, but each case can be different. and you will actually have to see perpetual arrangement. In some cases, it may be that the perpetual arrangement is effectively a form of ownership in an asset, which kind of continues forever. And in that context, it would be under Ind AS 16. So be very careful in terms of how perpetual arrangements have to be. And I did refer to evergreen leases. Like I said, it's a kind of a lease wherein there is a continuous renewal, right? There, typically, what I would have done is looked at, maybe estimated some kind of a lease term, after applying the requirements of the standard to say, okay, how often, what is the, how many renewals do I really expect are reasonably certain to be exercised and something like that. The other bits are because you refer to the asset and the enjoyment, etc., all those things. I just wanted to highlight, while I did say in this case, the transfer of control criteria is not met, but just to highlight that, why did I say that? And while it's there in the fact pattern to some extent, I just wanted to highlight a few things. There is an upfront payment here, which is a significant one. But if you see going forward as well, there is, for some period, there is a very nominal rental, then there is a rental which is 2.5% of the premium, etc. So one is that it's not really nominal in that sense, or the upfront payment doesn't really compensate for the fair value. Secondly, if you look at from the perspective of restriction, when we've been, and the reason I'm just spending 2 minutes on the control criteria is because we will see that in many of our issues that we deal with, and even probably the ones that we will discuss today. So without getting into too much of technical jargon, if I was just to say control, when I say I'm going to recognize an asset, when do I recognize an asset? I recognize an asset only when I have control over it, which means effectively I can, and like I said, again, I'm giving it in a very layman's term, I am able to direct the use of the asset. I have the ability, and I have the ability to direct the use, and I also get the future economic benefits from that asset. And that can be in any way. I can get the future economic benefits by just selling the asset, by using the asset, by hypothecating the asset. I mean, the benefits can be in various ways. So you actually apply that test. So in this fact pattern, actually, if you look at it, the so-called lessee cannot actually sell the asset further without the consent of the lessor. Even if they do get the consent of the lessor will take 50% of the unearned increase in the value of the asset. And even if the lessee wants to sell it, the lessor has a preemptive right of purchase. So frankly, that I don't think really matters, but that's just to kind of highlight. But the fact that, think about it, the future economic benefits are either from use or sale. So if I was to sell it as a lessee, the fact that the 50% unearned increase in the value will go to the lessor, that actually goes to show that I do not have substantially all the future economic benefits from the use of the asset. So I just wanted to highlight that control concept is very important in terms of, when you're looking at your ability to direct, you also focus on the future economic benefits. I think the second bit, I'll come to that, frankly, again, that the second bit also in this case is a bit contentious if you ask me. And again, I would say it's probably driven by the very peculiar fact pattern in this case. Now, let's say if I am the lessee, I would obviously apply the standard, and the standard says that you recognize a right of use asset with a corresponding lease liability. So to the extent, obviously, I've made the upfront payment, there will be no lease liability. The lease liability will relate to the future rentals. And you have an ROU. Now, the question which Mr. Gokhale asked is that whether this should be amortized, right? Now, generally, if you look at it, the standard says you amortize ROU. Okay. And okay, let me take a step back. The standard doesn't say that. The standard says you go to Ind AS 16 and apply the principles of depreciation. Now, here the EAC opinion has said that when you go to Ind AS 16, typically a freehold land is not depreciated, and that's what they advise, that you need not. I would just caution again, like I said on the other bit, please do not apply this just as is to all your cases. Okay, you really need to see, is it as good as your freehold land? Okay. If it's not that any land lease will not get depreciated. If I have a lease of 30 years, a leasehold land will get depreciated. So it depends upon facts and circumstances of this case. And just because I have a 90-year lease also does not mean I will not depreciate. Okay, it could be. I think the test would be that do we feel that this is as good as freehold land? Okay. If it is as good as freehold land, then the matter is different. But if it is not as good as a freehold land, generally I would I would take a different this thing. So I think the fact pattern in this case, like I said, are a bit more complex, and the opinion needs to be seen in that context. But if your fact pattern is different, unless and until you can demonstrate that the land that you've got or the interest that you have is as good as freehold land, I would actually, I mean, that's my personal this thing. But as far as this fact pattern is concerned, the EAC has said you need not amortize.
Right.
Archana, just one point here, just to understand, could you just highlight whether the principle or the concept of control for the purpose of classifying an item in PPE, property, plant and equipment, vis-a-vis classifying an item in ROU? So what is the level of stringency? What is the difference in the level of stringency when you look at a PPE test versus ROU test? So
I think I should have answered that. I think you did raise it in the initial comment also. So my apologies for missing that. I think that goes back to the concept of what is a lease itself. Okay, and the fact that we're recognizing an ROU. Now, what is the difference between a PPE and an ROU? In PPE, we say we control the asset, whereas in an ROU, you say you may not control the asset, but you have the right to direct the use of the asset. Okay, and there is a big difference between the two. So let's say, very simplistically, I have an asset which has an economic useful life of 20 years. I'm taking it on lease only for 5 years. Now, that does not really expose me to the risk and rewards of ownership. So when you look at control, the way control is defined, I'm repeating, I said control is your ability to direct the, your ability, you direct the use, you get future economic benefits, etc. Now, control, if I was to, there is more detailed discussion on the control concept, even in IFRS 15 or Ind AS 115. And typically, if you see, there can be various indicators of control. So it could be possession, physical possession. It could be legal ownership. It could be transfer of risk and rewards, etc. So just think about it. If an asset has an economic life of 20 years, I'm only using it for 5 years. I'm not exposed to the risk and rewards of ownership like of ownership. Because let's say after 5 years, if this becomes obsolete or there are technological changes or fair value goes down, it doesn't affect me. That risk is borne by the party who owns the asset in that context. So the Ind AS 116 acknowledges that while they're asking you to recognize, this question came up, how can I recognize an asset? I'm not the owner. So the concept under Ind AS 116 is, yes, you're not recognizing PPE. You're not saying you control the asset, but for the period for which you have the agreement. So in this example I took, I have, let's say, the right to use the asset for 5 years. Can I direct the use of asset? Okay. If during that 5 years of the arrangement, I can direct the use of asset, I would be considered as having a right of use. Now, what does direct the use of asset mean, which is what you raised, right? That's slightly different from risk and rewards of ownership. When I'm looking at right to direct the use, during that 5-year example I took, I will look at who will operate the asset, who takes the decisions, okay? Who takes the decisions relating to who will operate the asset, where will it be operated, when will it be operated, how will it be operated? So if these decisions during that 5-year are taken by me, then I have a right to direct the use. So if I take a very simple example, let's say if I take a car on lease, okay, so one is to say I've just taken a car for 3 days. Ultimately, who will drive? The vendor will decide whichever driver they send. I mean, which car they will send, etc. So I really have no decision making there. But let's say I take a car which is an economic useful. Let me not take a car example. Maybe let me take an example of a plant and machinery. If I've taken a plant and machinery for 5 years on lease, if I decide where will that plant and machinery be located, who will operate it, what hours will I operate it, how will I operate it? If those decision making is with me, then I have a right to direct the use of the asset. I may not have the control over the, in the context I spoke earlier, which is, all the risk and rewards of ownership. So the two are very different concepts.
Thank you. That was helpful. Thank you. So we can move to the next case study.
Sure.
Coming to case study 3, this looks to be a single slide question, but I think this is one of the most one of the longest EAC opinions when it comes to discussing the principles of Ind AS 116 again on leases, Ind AS 115 on revenue recognition, and Ind AS 40 on investment property. These the principles in all these three Ind AS have been dealt with by this opinion, and I think this will be a wonderful way to understand the linkages between three standards together. So coming to the fact pattern here, there was a corporation which is owned by the state government. The state government introduced a new industrial development policy, wherein it decided to de-risk the business by reducing the upfront costs of the industry's businesses concerned. So the corporation brought out the new industrial development policy, and brought out a model wherein the earlier outright sale of land was replaced with a composite lease come buy model. So there was a lease come buy model, which is an option given to the industries or the businesses concerned, wherein the land was allotted initially for a period of 33 years, with a buyout option of the purchase option given at any point of time after 10 years of successful implementing the project. So what, as an industry, I could have done, as a business house, what I could have done, I could have exercised the purchase option after 10 years of successful implementation of project by paying a 20% of premium on the allotment cost as a buyout premium, or as a buyout for it, or I could have exercised the option of extending the lease for a period up to 99 years. So after 10 years, what I could have done is I could have, without making any payment, I could have renewed the lease up to a period of 99 years, or by payment of 20% premium, I could have converted the land to freehold land, and the land would have been owned by me as a business. So the buyout premium was not applicable, wherein the allottees have paid the entire land cost in lump sum initially and successfully implemented the project within the stipulated time. So this 20% premium was again not applicable to those businesses wherein they have paid the entire amount upfront, and therefore when they exercise the option, they would not have had to pay anything after 10 years of successful implementation of the project. In addition to the land cost, which the company acquired from the corporation, the allottee had to pay annual lease rentals per acre, subject to a maximum of, there was a cap given to the maximum lease rental that would be paid to the state corporation during the period of the lease. Now, there were two types of leases which were offered. One was undeveloped land, where the land was offered on lease on a as-is where-is basis, and no development activity was undertaken by the corporation. In the second kind of lease, the development work was also undertaken by the corporation, and there were certain fees which was taken in for electricity, drainage, etc. Certain infrastructure costs were obtained were taken from the businesses concerned, and the corporation recognized those revenue as per Ind AS 115 as per sale for the amounts received for the developed land. Now, what the corporation did in respect of the lease out of these lands was it recognized revenue on execution of sale agreement as per Ind AS 115, revenue from contracts with customers. Further, the companies allotting land on lease basis, which are treated as operating leases, revenue was also recognized as per Ind AS 116. So the lease where the development cost was there was this Ind AS 115 was applied, as also Ind AS 116, wherein the corporation was allotting land on a lease basis, which were treated as operating leases. Now, the questions which were raised were very summarily raised, and the queries actually limited the opinion to very 2 or 3 pages of the fact pattern, and the queries were very, very wide. And there were multiple issues which were raised. Whether the lease that is being given by the corporation would be treated as a finance lease or operating lease in the books of the corporation concerned. How would the revenue recognition happen, particularly in the context, because there were, in case of developed land, where there were certain infrastructure charges being recovered by the corporation. The cost of lease, how would the cost be accounted? Whether the cost of lease would be debited to P&L as an inventory at the time of sale, whether the cost of lease would be reduced from the asset concerned directly. How would the cost of lease be accounted, and what would be the cost of lease that would be accounted for? what would be the treatment of premium that is received at the time of buyout option being exercised by the buyer? So if I'm receiving this 20% premium after the end of 10 years from the buyer concerned, how would I recognize this premium? And whether this land and infrastructure, whether I would treat this as an inventory or as an investment property, how would this be accounted for? So there were multiple issues which were raised. And in fact, if we look at the fact pattern, there are multiple complexities which were raised by the queries concerned. In fact, the option to buy, which is there, whether that would be treated as part of non-cancelable period of the lease, that was something which is required to be evaluated, or which requires evaluation to understand whether finance lease, whether the concerned lease is a finance lease or an operating lease. Again, the principles of operating lease versus finance lease are also required to be evaluated. Whether the present value, if it's not equal to the market value, whether that gives an indication of whether it's a finance lease or an operating lease. How would we evaluate land, particularly, specifically when you do not have to pay any cost for extending the lease up to 99 years, whether that would be treated as a finance lease or an operating lease. And concept of manufacturer or dealer lessors also I think another kind of lease which is discussed here in the query, and whether the concept of manufacturer or dealer lessors can be applied for the purposes of this lease accounting. So whether I would look at the concept of manufacturer or dealer lessors and account for these leases as a manufacturer or dealer lessor for the purpose of my accounting. So these were very, very pertinent issues. We can take up these issues one by one because these are quite complex issues and each issue would probably take some amount of time to deliberate. So Archana ji, would you just like to start?
So any initial comments?
Yeah, I think Vivek has covered it quite exhaustively. Let me just put 2 points in addition to so many that are thrown up by him. One is that because this is a sort of continuation, but if you can make that distinction, that here also there is a perpetual lease, but with an option to buy out. So it makes a slight difference in the fact pattern, because here the buyer lessee has the option to buy out the land. So that makes a slight difference. And also because the accounting by the querist, they are referring to accounting as per revenue recognition Ind AS 115 and also as per 116, that is lease accounting. So, although all that has been brought out by Vivek, how exactly these two interplay with each other, if you can bring out, that will be wonderful.
Okay. So I think this is slightly, see, the one that we did just previously was more from a lessee perspective. And this is, I think now we are looking at it more from a lessor perspective. And the good thing about the lessor perspective is Ind AS 116 doesn't change much from what was the earlier standard. So in terms of the lesser accounting, a lot of it is just being carried forward, and what we'll discuss probably may still be relevant even from an EAS perspective. Now, if you look at the scope of IFRS 15 or Ind AS 115, it scopes out arrangements which meet the definition of a lease. So again, the starting point here would be, do we feel this meets the definition of a lease? And if it meets the definition of a lease, then it will be outside the scope of Ind AS 115. Now, I wouldn't say that this is really perpetual, because this says it is 33. And then either you purchase or you extend to 99 years, if I've understood the fact pattern correctly. So in a way, it's a long-term lease, but probably not a perpetual in that sense. So I think given if I look at the fact pattern, I think there is a right to use the asset over a specified period of time in return for a consideration. So it seems very, based on at least what Vivek has shared, that the test of lease seems to be met. It doesn't really seem to be a transaction which is simply under Ind AS 115. But I'll come to that a little later. There is one element of what Vivek referred to as the dealer lessor, manufacturer dealer lessor. So while that is under Ind AS 116, right, it does have the concept of a sale as well, right? So per se, the standard which will apply to this fact pattern, to which I think the way the committee is also correctly concluded, is that this would be covered by the leases standard. Now, when we move on to, okay, if it is a leasing standard, then how do we classify? The first thing would be, of course, before you can really measure for a lessor, the first step is classification, because that classification of lessor as a finance lease or operating lease continues even in this standard. Now, because the principles are the same, I will not take the participants' time in terms of going through what is a finance lease, what is an operating lease. It's the same, so I will save time there. But if you look at what is the principle in a finance lease is, in a way you have the risk and rewards. It's more of a financing arrangement, whereas in an operating lease, it's more like a service kind of a thing. You want to use an asset for a limited period of time without becoming an owner. Whereas in a finance lease, you do step into the position of an owner, but with just a financing element coming. So let's look at it. If we look at this fact pattern from that perspective, the fact that the objective itself, was not to kind of really move from an owner to a non-owner kind of a situation. The intention seems to be to only lessen the burden, the financial burden in that sense, and maybe the cash flow for these that such a project requires. So one is from the objective, if you ask me, and then if I really look at it from the fact pattern, the fact that, there is an initial period of 33 years, but there is, in some cases, I can just renew or acquire. Let's say if I paid 100% upfront, after 33 years, I can purchase the asset without any additional money to be paid. Now, let me just take this case first. Now, obviously, if I've paid 100%, why would I want to continue under a lease arrangement? I've already paid, might as well also have the legal ownership. So there is a presumption that if someone's paid 100%, after 33 years, they will exercise this purchase option, which is what we standard considered as a bargain purchase option. You're getting it for nil. So if you look at a classification for parties which would have entered into such an arrangement, clearly it meets the test of a finance lease, because the purchase will get exercised, and that's the reason. There's reasonable certainty of that, and effectively the assets ownership will get transferred. Now, there are other arrangements as well. It could be that you did not pay 100% upfront, you paid some upfront, and the other was to be paid over the period, and so on. And the arrangement gives you that, yes, you can acquire at the end of 33 years, of course, subject to project being executed as per the required timelines and all those things. At the end of 33 years, you can, if I'm correct, that at the end of 33 years, I can exercise the purchase option by paying, say, 20% premium.
It's at the end of 10 years. It's at the end
10 years. My mistake. Sorry, yeah, 10 years. So if you look at the way of course, when the committee has analyzed this in more detail, they have concluded, based on the fact pattern correctly, that this 20%, the fact that I only have to pay 20%, which is much, much lesser than the fair value. Again, this represents but nothing but a bargain purchase. And even if someone was to exercise the renewal option, my understanding is that the renewal rental, let's say if I don't exercise the purchase option, I will go for a 99-year lease, right? Even then the rental during the renewal period is very nominal. It's something like 10,000, etc. So when you look at the second fact pattern, or the second type of customers, whether they renew the lease or whether they purchase the asset, exercise, either which ways, there is a bargain renewal or there is a bargain purchase. Now, when you factor that in, I think the case very easily stacks up that this is nothing but a finance lease, and that is what the committee has concluded. So I think two things I would conclude till here. Yes, it is a lease arrangement. Second, when you look at it from a lessor perspective, this meets the test of a finance lease because of the reasons that we just discussed. Maybe we can stop here before we go to the additional questions. Any comments till here, Vivek and Mr. Gokhale? Maybe then we can go to the additional bit.
No, I think that's perfectly summing up the current situation. Of course, then we need to move on, because having dealt with this aspect of the lease, then the revenue recognition aspect, which the querist has raised, as to what would be the critical factors in determining how you recognize the revenue and when you recognize the revenue.
Okay, so I'll come to the dealer lessor, but sorry, I think I missed one point, my mistake, is that when you look at the arrangement, apart from giving the land, etc., I think there are additional services also being, while that's not a big part of the query, but there are additional services like electricity supply, etc. Just wanted to highlight there that if you've got lease and non-lease components in a transaction, you can either account for the two separately. I mean, you take if the non-lease component is a service, electricity supply, you can go to Ind AS 115, or there is a practical expedient which the standard provides that you can account for the non-lease component as well under the Ind AS 116 itself. But that's another bit. And the other is that when I'm looking at, we did talk about there can be various types of customers, in that sense. Do I need to make this finance lease, operating lease classification by each contract? You can do that. And the standard also permits you, again, a practical expedient that you can do it at a portfolio level, provided the contracts are similar and the outcome will not very, very much differ. Now, finance lease, coming to your point, sir, you said on the revenue recognition. Now, in this fact pattern, effectively, the company is acting as a dealer lessor. What do I mean as a dealer lessor? It purchases land, and because it is entering into a finance lease wherein we said the intention is to transfer the risk involved. In a finance lease, the lessor does not recognize the PPE. So the land that they have, which they've given on PPE, would not be recognized as PPE by them. They will only have a finance lease receivable, which is what we call the net investment in the lease. So you think about it, the company acquired land, then it only, when it has given this further on lease, it will only have a finance lease receivable. It will not recognize land. So then how does this land get accounted for? So let's say I'm taking just a very simple example. Let's say I acquired the land for 1 crore. When I gave it further, I gave it at, let's say, 1.5. But that difference of that 50 lakhs had two components. One was my profit. So I wanted to sell the land which I acquired at 1 crore, I wanted to sell it for 120. So 20 lakh was my profit. Had you paid me 100% upfront, let's say I would have sold it to you for 120, okay, 1.2 crores. Then that goes to show my 20 lakhs was nothing but my profit. But because you are paying me over an extended period, let's say I'm charging you 1.5, which means that 30 lakhs is nothing but the financing element in a very simplistic term. So what the standard says is that if you're a manufacturer, dealer, dealer lessor, which means that you have some profit element as well. It is not just there is a financing element. One could be, think about it, a bank. Bank typically doesn't buy. Bank is only going to give you finance to fund, right? So the bank doesn't intend to make any capital appreciation on the land typically. They will only have a finance income, but a dealer lessor will have two components. They will actually have a profit that they intend to make on the underlying item. And then the fact that there is a delayed payment, in that sense, there is a financing arrangement, the finance income will come in. So in this fact pattern, again, when you look at the way the transaction is structured, it appears that the company meets the dealer lessor test. So let's say if I was to sell the property to someone today, what is the value that I would have got today is what my fair value of the, the transaction price would be. And the difference between that and my cost of acquisition would be my profit, which should be recognized immediately. And the balance would be my financing, which should be recognized over the period as per the standard. So there would be two elements in this fact pattern because the party is a dealer lessor.
Yeah, so I think that brings us to the issue that you have rightly highlighted, that the party is a dealer. So one of the questions that has been sort of posed by the querist and answered by the committee is that in the hands of the corporation, the querist, how does one account for because there seems to be, as you have explained, reasonable certainty or expectation that the buyer would exercise the option of buyout. But pending that and pending even the other transactions being complied with, also they have highlighted that what was the practice in the past. So how would the querist account for the unsold or undealt with land, and how would that be reflected in their financial statement?
So the classification of land typically depends upon the intended use. So let's say if I'm buying land for sale, clearly it is inventory. If I'm buying land for capital appreciation, or if I'm buying land for rental, etc. So I think typically that is how the classification of land would be. But let's say if there was undetermined, if for whatever reason the use of land was had not been determined, then typically it is classified as investment property. When you look at this fact pattern, the fact that the company typically leases out the land parcel on finance lease, it gives a purchase option, which is reasonably certain to be exercised. And also the fact that this was exactly their, objective even prior to the change. All that they've done is they've only kind of tried to reduce the burden on the customer, right? But their intention or the objective of how they want to use the asset has not really changed. So the fact that this has been transfer the risk and rewards, the committee has concluded that this would therefore meet the test of an inventory, and that is how it should be recognized, which I think makes sense, because clearly the land is not being held in this case either to earn rental or for capital appreciation. I don't know whether you have any comments, Vivek.
No, I think very crisply summarized. The only point which I think should be just kept in mind is, even if the buyout option is after the end of 10 years, the lease period will, as per the lease standard, the lease period will continue to be taken as the initial period of 33 years with an option to renew, because when there is a bargain purchase, the period when the bargain purchase is exercised, the non-cancelable term will not be affected. So as to say, the purchase option, when I can exercise the purchase option at a nil value or at a very nominal value, which is lower than the market price, that would not affect my determination of the lease period. I think that's something which was relevant. I think this was a very wonderful case study dealing with three important principles, three standards, wherein we discussed on India's 116 revenue recognition, as well as whether a particular finance lease would be classified as an investment property, or whether lease out, or whether the intention is to sell the land concerned, whether it would be classified as inventory or investment property, even though it's immoral property per se, so as to say. And we discussed all those principles in depth here. We come to the next case study. This is a case study which is in respect of property, plant and equipment, India's 16, wherein we discuss on whether a particular item
I think just go out of the screen share and then come back again.
Yeah, I'll do that.
Yeah.
It's visible now. Yeah.
Yes.
Yeah. Coming to the fourth case study, wherein we discuss about the principles of capital expenditure and revenue expenditure in respect of an expenditure incurred in respect of construction of infrastructure, transmission infrastructure by a company which is not owned by it, which is not legally owned by it. And there are certain restrictions again which are imposed on the infrastructure which is constructed by the company concerned. So this company which is there is engaged in the refining of crude oil and having a present refinery capacity of 3 million metric tons per annum, which is being proposed to be enhanced to 9 million metric tons. The company is presently running this refinery from its own captive power plant, but due to this increased capacity, it is planning to purchase the power through the grid, and therefore, and to ensure that there is a stability in the connection, it has therefore approached the State Electricity Grid Corporation, which we refer to as C Limited, and has entered into an MOU where the company, wherein the company would be required to set up the infrastructure for the import of grid power, and to ensure this reliability and availability of power to sustain the operations of the refinery which is being expanded. Now, the grid has agreed to take up the construction of infrastructure up to the boundary of the company, and the rest, and for facilitating it to procure power from the grid. The cost, however, for this building up of the transmission infrastructure would be borne by the company only. The total expenditure that would be incurred by the company would be comprised of three parts. One is line up to the company's boundary, which is the overhead line up to the company's boundary. This line would be owned and operated by the grid only. So although the cost of this infrastructure will be borne by the company only, but the line will be owned and continue to be owned and operated by the grid concern. Insulated substation would also be required to be built, which would be located near the refinery complex. And this again would be owned and operated by the grid. So although the cost is being incurred by the company concerned, the ownership and the maintenance thereof would be continued to be done by the grid. The third part of the cost would be a switch yard, which is inside the complex of the company. That, however, will be owned and operated by the company. So the cost of this will be incurred by the company, and it will be also owned and operated by the company concerned. So although this infrastructure, which is created to meet the enhanced power requirement of the company, the grid has the option to sell power to household or other industry in and around the refinery area from the grid, after meeting the company's requirement from the transmission infrastructure. So, of course, the transmission infrastructure, the cost of which is being borne by the company concerned. Of course, priority or the fact it will serve the requirements of the company concerned, the power requirements. But the surplus power, the grid would have the right to sell that power to the household or other industry which is located in and around the refinery area. So the exclusivity is not available with the company, and the grid would have that discretion to sell the power to the nearby area. So the question which arises here is this expenditure which is being incurred by the company. This asset, so as to say whether it's an asset or not, is a question that we need to answer, whether this cost that is being incurred on the entire infrastructure would classify as a capital expenditure or a revenue expenditure. Whether expenditure can be recognized as an individual item of a property, plant and equipment, whether it is identifiable, or the same would be capitalized as an overall cost of the project. So we would request the panelists here to just evaluate the principles of intangible assets also, whether this would fall within the definition of intangible asset, whether it is an identifiable asset, whether it would form part of the overall cost, or would it form part of the revenue expenditure only. So we need to evaluate, particularly keeping in mind the fact that this infrastructure is, although the expenditure on this infrastructure is being made by the company concerned, by the company which is running the refinery, the ownership and maintenance or the operations are being maintained by the grid only. So we would request the panelists to throw light on this case.
So I'll request you to take the lead on this, but my just one or two aspects which I may, if I just request you to kind of consider.
Yeah. Okay.
So you know, when I read this, I think there's so many, and I'm sure for the participants as well, all these questions will come to their mind. You know, and given the fact that we have now so many categories of assets, when you look at this, the first question is this a PP? Is this a, you know, ultimately they're all forms of asset. You know, even the main question is revenue or capital. But even if it is capital, is it a PP? Is it an intangible? Again, I'm going to go back to, is it a lease? I'm going to bring that in everything. So is it a lease, or how do we now really, how do you kind of evaluate this fact pattern to say, okay, which category of asset, even if you do conclude it's a capital expenditure and not a revenue, how do you reach that conclusion? And should we first start with the PP assessment? Do we start with the lease assessment? How do we look at this?
I think very important, and also I suppose that a lot of the members who are logged on, we can't see their membership numbers, but quite a few youngsters would be there. And what I feel is this is like a typical CA final exam question, that you feel you have answered the first part and there is a twist in the tail and there are still two more supplementary questions that need to be addressed, which in real life is very important, as you said, because you know, sometimes you feel you've got the answer, but there are two supplementary questions that still need to be examined and still answered. So let me touch upon two important things, looking at the time, because I'm sure there are many other aspects that we need to deal with quickly in the remaining part of the queries that we have. So I'll try and be brief on this, that basically this sort of question has been coming up frequently before the EAC, whether capitalized, whether it is owned, asset is owned and controlled, and so on. So let's look at the essentials. First and foremost, very quickly stated, cost is being borne by the querist company C, but company, whatever that name is, the cost is being borne by the company. However, very importantly, the distinction which one needs to make is that, and that has been given in the answer as addressed by the committee, that first and foremost, you have to see whether it meets the definition of an asset. And the second part, which is equally important, is whether it meets the definition of control. Because undoubtedly, economic benefits from all the three, whether it's the overhead, that is the whatever that transmission lines are, and then the substation is concerned, and the yard, all three will result in economic benefit to the querist company. But whether that is part of the asset directly, and if not, whether it becomes indirectly something that you need to capitalize, are the two major aspects that one needs to deal with. So very briefly stated, I'll not go into the details. They are there in the answer that is given. The overhead cables and the substation, both are undoubtedly constructed by the third-party company, but at the cost of the querist. However, the most important aspect of control, that, and this one aspect which is something which needs to be emphasized at all points of time, is that control does not merely mean that, okay, they are virtually going to have, they have not had so far in the given fact matrix, that they are going to enter into an MOU. However, there is an indication that they would generally not be using it for distribution to third parties. That small exception that they can use it for sundry uses within their vicinity is typically where in a power plant you'll have some retailers, some shops for catering to the requirements of the colony of staff, etc. But by and large, it is all meant for captive consumption by the plant. So clearly, economic benefit flows. Whether that results in control on the first two parts of the expenditure, the overhead cables and the switchyard, sorry, not the switchyard, the substation. So both these are effectively controlled by the company which is setting up these plants, setting up these two facilities. And not only that, there is absolutely no indication that third-party usage can be restricted by the consumer, by the company, by the querist. So therefore, the aspect of control being lacking, one cannot say that this can form part of the fixed assets which will fall for PPE within the direct control of the querist. So that is the first part. Let me move on further, just to sort of look at the third part. What is it that distinguishes even the third part? If you see the fact matrix, it is that the same company will set up the entire switchyard also. They will actually do the RFP, they will do the tendering, they will supervise. Yet, A, it is in the premises of the querist. B, it is absolutely under the control of the querist. And therefore, the first issue is that, is it therefore an asset of the querist? The answer has been given that yes, it is an asset which meets the requirements of PPE. So that is broadly the first part. That means of the three assets, the first two do not directly fall under PPE. The third does. We will come to the aspect of right of use, lease, etc., which Archana ji had said. Unless you have something to add at this stage, Archana ji, or Vivek, anybody wants to add something, or should I move on straight away?
No, I think it's fine. I think the only bit I just want to add is at least the nuances which come in as to how the control concept is applied for all standards. I think even when we look at, and there is similarity, I don't want people to get confused. Even when we're talking about, one is, I'm just making a distinction between ownership and control a little bit, because when you look at an intangible asset, again, they'll be talking about control over the asset and so on. So I just wanted to highlight that here.
Right. So I think, yes, that is something that flows common. And as I said, a lot of queries are coming in this regard because this is becoming an increasingly common pattern. So the company C is going to be actually effectively controlling asset, that part A and B, I'll not refer, I get confused with that. The switchyard part is what is going to be controlled by the querist company. So that is so far as that is concerned. Then we move on, that having decided that, the second part is, do we straight away then say that since it is not an asset, do we expense it off as revenue in the year when it is incurred? Or is there some methodology that we need to look at? And the answer to that has been given by the committee itself, which considered this aspect. They looked at it, that does it actually contribute? And this is where again the word, directly attributable, that again comes in the PPE concept, that are these costs or are these expenses incurred result in something which is directly attributable to bringing the eventual power plant into being in effective use. And the conclusion based on the facts is that yes, without having this power, without having this entire infrastructure which is built by company C for the querist, without having the substation and without having the switchyard. Switchyard, of course, we have capitalized, but without the first two, you would not be able to make the plant operational, because without that power, that plant would not become operational. So the answer to the second limb would be that, yes, it is part of something that is indispensable for setting up that plant, and therefore one needs to allocate this cost. It would be quite disastrous for the company in a practical sense also, and not technically correct to expense of that entire expenditure on the overhead cabling and the substation. So that, of course, on a practical manner, using engineering estimates and so on, whatever are the technical parameters, that cost would have to be spread over the relevant parts of the plant that you are capitalizing. So that would be the second limb. Of course, the third issue as to whether that needs to be treated as a right of use, and therefore one can look at it as an intangible asset. That's where I said it's like the CA final question. It's a trick question, but I don't think I need to go into detail, but to say that the committee has dealt with that aspect. They have concluded based on the fact that it really, again, that element of control is what is critical. So if you don't have the control, you can't consider the right of use in the sense that you can really apply that concept over here. And therefore, the apportionment of that value of the first two parts of the contract should be apportioned over the eventual PPE that you will capitalize, and that's how that is to be treated. There is, of course, the last issue. I'll jump straight to it unless you have something to add as to how one treats the money advanced. That was the part of the query.
Maybe you can quickly cover the money advanced, I think, because then we can come back to this main issue. I think I don't want, in the interest of time, I don't want the advance bit to be left out. We'll come back to this one. I think there are two very key important points I just wanted to pick up.
Yeah, please. Yes.
Do you want to just, maybe we can just quickly cover the advance first and then come back to this?
No, okay. So advance part is fairly simple because they have mentioned at two places that it is under the entire construction done by company C is by a, they call that, that is on, I'm forgetting the word. It's done on a work allotment basis. I'm forgetting the exact word. So, so that is done by them by deposit work. Sorry, it is a deposit work, which is a standard term in government contracts. So it is handled as a deposit work. So what happens is it's like an impressed account. So the committee has rightly said that since that money is paid and then that is used towards the work that is done on your behalf, it will get capitalized into WIP until the time that that is eroded, and that capital advance get converted into WIP and so on. But eventually it will be reflected as capital advance until the time that it is capitalized directly or indirectly, depending on whether it is part 1, 2, or 3 of that. But yes, Archana, you had some other points that you wanted to.
I think again, just because we want the, everyone to get a larger benefit from just beyond this fact pattern. So that's why I just wanted to take this a little forward. There was a point of time when the gap was very easy. You never had to spend time with standard to apply. You actually knew this is a relevant standard and then you got into it. Now, I think as this question illustrates, the bigger question which comes is, which is the relevant standard? Identifying the relevant standard itself can be an interpretation, is the point I was trying to make. Now, how do you really start? Now, in this fact pattern, at least the way I understood for myself, is that I mean, if let's just say this, there was no committee opinion, where would I start off with? How would I know which standard to apply? The fact that there is something which is constructed, the first issue comes in your mind is, okay, is this a physical asset which needs to be recognized by me? Recognition of a physical asset will first take me to Ind AS 16. And like you said, because I don't control, okay, I don't have those ownership benefits and risk and rewards of ownership, and I don't control, it moves out. Now, I would look at it, fine, I have some right to get benefit from it. I'm not the owner of that. But like you said, it doesn't seem to be like an expenditure in the revenue context. It seems you have some future economic benefit. So if it is not a physical asset, then what kind of an asset? Then you go to say, do I have a intangible asset and or some kind of a right? So if you look at it, intangible asset is also a right of use, and Ind AS 16 right of use asset is also a right of use. The way I look at the difference between the two, again, in a very simplistic way, if I have a right of use of an intangible item, let's say a software, I would go to Ind AS 38. If I have a right of use of a tangible asset, typically I would go to 116. Though again, there are certain provisions under Ind AS 116, intangible asset also I can account for under 116. Okay, but I'm just think simplistic. I would first see, is there a physical asset which I control? Go to 16. If I say no, then I would see, do I have a right to use? If I have a right to use the intangible, go to 38. If I have a right to use the tangible asset, but not the ownership, then I would go to 116. Now, what I understood is, because of the this control bit that we've been discussing, my Ind AS 16 criteria fails and my Ind AS 38 criteria also fails. Now, when I come to Ind AS 116, it fails. That's the reason I was very interested that why does the lease fail here? Because here, while I get a right to use that, I'm not, if I'm going back to what Vivek had raised, what is this right to control, to direct the use? I'm not directing the use of the asset. I will get the power from there, but I'm not saying how that facility, when, where, how, what should that facility be operated. So surprisingly, while intuitively we all feel there is an asset, it doesn't meet the physical asset test. It doesn't meet the intangible. It doesn't meet the lease test. And I was just trying to get the picture clear in the minds of the participants to say that don't get confused. They all have their own relevance, and whether it's a physical asset, whether it's an intangible asset, or whether it's a right of a physical asset, you will decide the standard. Now, one variation which I was very keen to discuss here, because when we concluded 16, 38 and 116 not applicable, you said that you will take it as something which you will allocate. And effectively, you've applied what we generally refer to as the concept of enabling asset. So let's say if I've constructed a road on public property while I don't own that road, the EAC or the standard also permits that you can allocate that. So you've applied that analogy, and it is quite helpful. But I wanted to bring in one more element, which could be a variation. Again, like I said, each fact pattern can be different, and this opinion should not be applied just to all. So let's say that I'm taking the services of power transmission, and I will pay apart from what I'm paying for this asset, I will also pay the charges for the power transmission, right? Now, let's say, had I not contributed, let me not say constructed, had I not contributed to this construction, I would have paid, let's say my service charges for this would have been, let's say 100 for a month. But because I have incurred this, let's say the company says, you've paid me here, I will adjust it. You pay me only 80 for the month. Then I would say this is not an enabling asset, like you said. I would say this is an advance which I have paid for my service charges, and I will adjust. In this fact pattern, I think we need to appreciate, probably we did not pick this up and it's not very evident from the fact pattern, that there was no adjustment to the charges that you will pay for the services. That is still being paid at fair value. So because the services are still being paid at fair value, I think we land up to the answer that you recommended. But my understanding is that, let's say, and I'm now going beyond the EAC query, let's say if in view of the money which I have paid for this, there was some reduction in the charges that I would have otherwise paid, this would be akin to an advance payment for that rather than an enabling. That was the bit I just wanted to say.
Yeah, in fact, let me throw some additional light on this very appropriate issue that you raised. Perhaps the EAC also steered clear of this issue, because if you see, they've mentioned that the MOU is yet to be entered, and there is an indication that they will be paying the commercial price for the power purchase, but there is no certainty in that regard. So perhaps neither the querist nor the EAC has touched upon this aspect. You have rightly brought it out that yes, this could be a factor for consideration in practical terms. So I think I would really highlight in summing up to the participants is that things are not always as simple as they appear, A, and B, you have to go through that checklist of eliminating option 1, option 2, option 3, and then perhaps you'll come to option 4, which may appear to be the most viable option, as we have come by process of elimination. So I think that very beautifully brings out this aspect. Yes.
Yeah. No, it's just that because, this, I feel this contribution, because especially this fact pattern was in the context of a power, while not, it was power transmission, not power generation. But I think typically in the power sector or the utility sector, this arrangement is very common, wherein the customer incurs the cost for the infrastructure. And I think the first question that becomes is who controls the infrastructure? If it's the supplier, then that capitalizes. If I control, then I capitalize. If I'm not controlling, like you said, then you also need to see, am I going to pay for the power, etc., whatever services I'm taking at fair value. So for utility sector, because these kind of arrangements are very common, and now we are seeing this beyond utility sector also, I just wanted to highlight that.
Absolutely.
Just one more point here. Whenever we look at these kind of enabling assets to be capitalized as part of property, plant and equipment, we need to keep in mind, just for the benefit of the participants here, the principles of impairment. So that is something which is very, very, we should be mindful about. And impairment is something which we often sometimes forget to apply the principles of impairment when we look at the account, often in enabling assets, so as to say. The fact that this, yes, Archana.
Yes, sir. You complete.
Yeah. So the concept of, therefore, this case study actually brought out a very fine distinction of identifiability of a tangible asset or identifiability of a property, plant, and equipment, and the concept of control. Why the lease standard also fails, because the right to direct was absent, and I think we looked at how the control principle actually is a very important principle across all standards, so as to say, as Archana ji and Jain sir also pointed out about the principles of control being present across standards, even in revenue recognition, for example, or risk and reward. This principle probably, as something which we need to evaluate and understand in depth. Archana ji and Gokhale sir, your concluding remarks, because I think we had certain reserved case studies also. We could not complete the 5 case studies as well, but your concluding remarks on.
I just wanted to make one comment before we give it to the chair and vice chair, is that one is, I think, even when we were discussing this for the session, when you go through these opinions, you really realize the value which is available through these opinions. I mean, it's a treasure, I would say, and I would actually encourage everyone. But only with a word of caution, you do have this benefit which is available to you, this repository, but use it with caution. Please, each fact pattern, every small change in the fact pattern can change. I think it is very brave of the ICI to put these up. If I was in the position, I would say, listen, what if someone really doesn't really understand the nuances? So I think it's very brave they've put it up, but I think then we're also trusting that members would be very careful in terms of applying and seeing how they fit into their facts and circumstances. And one last thing, I think, to what Chairman said in the beginning, even though not mandatory, personally, I feel if it is coming from the regulator, I would actually have a very high bar before I say, okay, I disagree. Or I may disagree, that's another thing, but that I will not adhere to it. I should have a very high bar unless until you can really demonstrate that the fact pattern is so different that the opinion doesn't apply. But if the fact pattern really fits into what the EAC has considered, I would have a very high threshold to say, legally they're not mandatory, why should I would generally actually just encourage everyone to respect and the fact that it's coming from the institute and apply it accordingly. Sorry, sir.
Also, Chairman sir, if you permit, just one word to add to what Archana ji mentioned, that having been in practice at the field level for a long, long time, I can tell you that these opinions, when you produce them before the CFOs or the finance team of the company as a practicing auditor, they are of immense value because there is virtually no argument against them, provided, as Archana ji said, you can match at least reasonably the fact pattern with the conclusion. So therefore, these add awareness of this will strengthen your case, whatever it be, whether you're in agreement with the management or not in agreement with the management, whatever stand you are taking, it helps immensely to be conscious of what opinions have been given and how they are thought through. And I think the way that they are recorded is fantastic. That's it. Thank you, sir.
Thank you, sir. Thank you. Oh, it was a privilege, sir, moderating this session with two stalwarts like Gokhale sir and Archana ji. And I think, the principles which are laid down in the EAC opinions are a treasure trove. Actually, we learn so much from EAC opinions, all of us. I think that's a wonderful job being done by the institute here. Thank you. Over to Chairman.
Thank you, Vivek ji. Thank you, Jain ji and Archana ji. In fact, more than 1,400 members have already benefited out of it. And of course, it would be available on the ICI TV later on, so anyone can again go and use it. And not only these opinions, maybe in future also we'll be doing it, but all the existing opinions, you can search to the searchable mode, which was told by our Vice Chairman Vishal ji. So it was all fantastic. So concluding, I'll request our CA Vishal Doshi ji from Vadodara, our CCM, to please conclude.
Thank you, Chairman. Friends, it has really been a very, very interesting session, and I would say a very interesting debut for the EAC with this webinar. Over 1,500 participants, and I say that it has the panelists and the moderator has very lucidly explained the opinions, I would say the facts of the case, what was considered by the EAC and what was the final conclusion. So my heartfelt thanks to the panelists Jayan ji and Archana ji for their valuable time and their detailed insight into each of the opinions. My special heartfelt thanks to Vivek ji for steering the ship for the last 2 hours, I would say, and ensuring that all the nitty-gritties of the cases are produced before the participants are so that they are able to understand the nuances and able to appreciate the facts that have been considered and also the opinion that has been given by the EAC. I think we were a bit short of time because everybody was so much involved in the detailed deliberation, and in fact, that is what I think the participants were also looking up to, and therefore, all I can say right now is that for the participants is please look out for this space. We'll be back very soon with the remaining opinions and maybe with some new opinions also into our so that we continue this exercise that we have started today. So thanks to everybody. Thanks to the office, Parul, Gupta ji, Khushbu, everybody who has been at the helm of affairs for bringing this live to all of you. Thanks to all of them. And thanks to the technical team. Thank you and have a very good evening. Thank you.
Thank you.
Thank you. Thank you.